Right now, if you pull up the latest retail sentiment data from IG, 78% of retail gold traders are long. That's an extreme number. That's higher than it was at the peak of the April rally, when gold hit 4,700. They're buying every single dip, no matter how small, betting that the monthly bull trend will just keep pushing us higher, that central banks are going to catch the fall, that this can't go down too far. But here's the thing, they're all walking into the exact same trap. The same exact trap we saw back in March, when 76% of retail traders were long, right before we dropped 7% in 10 days. The same setup, the same sentiment, the same exact positioning. There is one danger zone and one hidden opportunity right now. I'll show you both. I'm not talking about some vague, generic analysis you see everywhere else. I'm talking about the hard, institutional-grade data that only the big funds get to see, the data that's telling us exactly where price is going next. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. No guesswork, no wait and see, no vague support and resistance that could mean anything. Just the exact numbers, the exact triggers, the exact risk management rules that institutions use to profit from these exact setups. Because right now, most traders are going to lose money on gold this week. But you don't have to. If you stick with me, if you follow this plan, you can be on the right side of this move. Let's cut straight to the verdict. No fluff, no beating around the bush. Right now, we are in a short-term bearish trending session. This is not a pullback in a bull market, not yet. This is a full-on correction, and it's accelerating. The single invalidation level that flips this entire bias, that turns this bearish move back into a bullish dip? 45.50. Write this number down. If we break 45.50 on a daily close today, the entire structure resets. Every single bit of this bearish thesis goes out the window, because that would mean that buyers are back in control, that they've pushed through all that resistance, that the selling pressure is gone. But right now, that's a low probability move. Because right now, the herd, those retail traders I just mentioned, the 78% that are long, they're all piled into the exact same position. They're looking at that monthly strong buy signal, they're seeing the headlines about central banks buying gold, they're hearing that long-term forecast that says gold is going to 5,000 by the end of the year, and they think this is just another chance to get in cheap. They think that every dip is a buying opportunity, that this can't go wrong. But what they don't see is that the short-term institutional money, the money that actually moves the price day to day, is bailing. They're bailing at a rate we haven't seen since March. The latest Commitments of Traders report shows that hedge funds cut their net long positions by 12% in the last week alone. That's the fastest cut we've seen since that March sell-off, when we dropped 7% in 10 days. That means there's no one left to absorb the selling pressure once we start moving lower. All the buyers are already in. All the latecomers, all the retail traders, they've already bought their positions. There's no one left to buy from the sellers. That means when the selling starts, it's just going to cascade. Price is going to drop faster than anyone expects, because there's no bid to stop it. The herd is always wrong at these inflection points. Always. When you get 70% plus of retail traders on one side of the trade, that's when the market moves the other way. That's the pattern, every single time. And this is one of those times. You can feel it, right? The market is too optimistic, everyone is buying the dip, no one thinks it can go down. That's exactly when it goes down. Now let's pull up the charts, start from the top down, because that's how the big institutions read them. They don't just look at the 1-minute noise, they don't just look at the daily chart. They start at the weekly, then the daily, then the 4H, then the 1H, so they can see the full picture. That's what we are going to do right now. First, the weekly chart. You can see it clear as day, right? The weekly trend is sell. We've been pushing lower for 3 weeks straight now. We had a peak back in mid-May, when we hit 4,620, and we've been grinding lower ever since. The first level we hit was that 4,561 resistance, the level we rejected 2 weeks ago. That's the level we couldn't break. And since then, we've just been moving lower. The weekly MACD. It crossed below the signal line last week. And that momentum is accelerating. We are not seeing any bounce, not on the weekly time frame. The histogram is getting bigger, the negative momentum is getting stronger, there's no sign of a turn yet. Now move down to the daily chart. This is where the action is right now. This is where we can see the short-term trend clear as day. The daily trend is strong sell. We've closed lower 4 days in a row. 4 days straight, no bounce, no relief, just selling. Look at those moving averages. Let's go through them one by one, because they tell the whole story. The 5-day moving average? That's the short-term trend line. It's sitting at 45.13. Our current price? 4,484.60. We are below that. The 10-day moving average? That's at 45.31, even further above us. The 20-day moving average? That's at 45.64, way above us. All three of those short-term moving averages? They're all pointing down now. They're all stacked above our current price. Every single one of them is now acting as resistance, not support. That's a classic bearish alignment. That's the kind of alignment that tells you the downtrend is strong, that it's not stopping anytime soon. Then you have the longer-term moving averages. The 50-day moving average? That's up at 46.54. We haven't been near that in over a week. The 100-day? That's at 46.24, also way above us. Those were our support levels back in April. But now they're so far away it's not even funny. The only long-term support we have on the daily chart, the only thing that's stopping us from crashing even further? That 200-day moving average, sitting right at 43.85. That's the level we talked about in the title. That's the make or break line. That's the level that the central banks are supposedly defending. That's the level that the bulls are all counting on to hold. Now, let's talk about the momentum indicators. The daily RSI. It's at 41.44, right? It's dropping. It's been dropping for 5 days straight. We are not at oversold yet, not even close. Oversold is 30, right? We are still 11 points above that. That means there's still plenty of room for us to push lower before we even get to the level that would normally trigger a bounce. That means this sell-off can keep going for days before we even see a hint of buying pressure. The MACD. It's at minus 37.83. It's been dropping for 5 days straight. No positive divergence, no sign that buyers are stepping in. The momentum is just getting stronger to the downside. Every day, it's getting worse, not better. Now move down to the 4-hour chart. The 4H trend is strong sell, same as daily. We've got lower highs and lower lows. Every single pullback is getting sold into. You can see it on the chart, right? Every time we bounce 10 points, we immediately drop 20. There's no strength to the upside at all. The 4H moving averages? Same alignment, all stacked above us, all acting as resistance. The 1-hour chart? Even worse. Every bounce is getting faded within an hour. There's no buying pressure. No one is stepping in to buy the dip, not the short-term traders anyway. The only people buying are the retail traders, the ones who don't know any better. Now, cross asset? You've seen this, right? Gold is moving tick for tick with real yields right now. When the 10-year yield popped back above 4.6% yesterday, gold dropped 1% in 2 hours. Exactly 2 hours, tick for tick. When the dollar index hit 104.5, gold dropped another 0.5% immediately. There's no decoupling here, not right now. Gold is acting exactly like it should when the Fed is hawkish, when yields are rising, when the dollar is strengthening. Because gold doesn't pay you any yield. When you can get 4.6% on a 10-year treasury, risk-free, why would you hold gold that pays you nothing? That's the core logic here. That's why gold is dropping. And as long as yields keep rising, as long as the dollar keeps rising, gold is going to keep dropping. There's no way around it. Here's what most traders miss. They look at that monthly trend, that strong buy, and they think that means this sell-off is just a dip, that it can't go too far, that the long-term trend will save them. But the monthly trend doesn't protect you from a 5% pullback in the short term. It doesn't protect you from a 7% pullback, even. In fact, the last time we had this exact same setup, monthly strong buy, weekly, daily, for XAUUSD, we dropped 7% in 10 days, back in March. The same exact thing happened. Retail bought every dip, got trapped, and then we crashed right down to the 200-day MA. That's what's happening right now, and most traders are too busy looking at the long-term chart to see the short-term crash coming right at them. They're too busy reading those headlines about gold going to 5,000 to see that we are about to drop 100 points first. They're too busy buying the dip to see that the dip is going to turn into a crash. And that's the trap. That's the trap we've been talking about. Now let's talk about the fundamentals, because this isn't just technicals. This isn't just lines on a chart. This is being driven by hard, concrete news from the last 24 hours. News that most traders are ignoring, because they're too busy looking at that monthly chart. Remember that Middle East tension everyone was betting on last week? The war with Iran that was supposed to send gold to 5,000? The one that was going to cause a massive supply shock, that was going to trigger a huge safe haven bid? It didn't happen. The weekend passed. No escalation. No attacks. No new geopolitical risk. In fact, we got optimism about a ceasefire deal. We got word that the US and Iran are close to an agreement to extend the ceasefire, to open the Strait of Hormuz, to de-escalate the whole situation. That safe haven bid that was propping gold up over the last 2 weeks? It vanished overnight. Just like that. That's why we opened this morning down 0.8%. Straight out the gate. No warning, no nothing. The bid was gone, and price dropped immediately. Then we got the Fed speakers. Yesterday, we had 2 separate Fed officials coming out hawkish. First, we had Waller, you know him, he's one of the most influential voters on the FOMC. He came out and said that inflation is still too high, that it's not coming down as fast as they thought, that they might need to hike rates again, that the market was wrong to price in cuts this year. Then we had Bowman, another voter, she said the exact same thing. She said that if inflation doesn't keep falling, they're going to have to hike rates more. That sent the 10-year yield right back above 4.6%, the dollar index right up to 104.5, and that crushed gold. Because when rates go up, gold doesn't pay you any yield, right? It becomes less attractive compared to bonds, compared to dollars. That's the core driver here. That's the thing that's moving price right now. Now, what about the institutional positioning? I mentioned this earlier, but let's break it down, because it's so important. We've got this massive split right now in the market. Long-term, central banks are still buying. They're buying the dip, they're locking in long-term positions, they're diversifying away from the dollar. That's why the monthly trend is still strong buy. That's the long-term story. That's why gold is going to go higher over the next year. But short-term, hedge funds, the money that moves the price day to day, they reselling. They're cutting their net long positions. They're taking profits from the rally we had earlier this year. They're positioning for higher rates. They're getting out of the way of this sell-off. And the ETF flows? The short-term ETF money is flowing out. We saw $120 billion in outflows back in March during the last sell-off, and we are starting to see that same pattern again. The GLD ETF, the biggest gold ETF, we saw outflows of $420 million in the last 2 days alone. That's the short-term money leaving. Retail is buying, institutions are selling, central banks are buying the bottom. That's the split. That's why you have this divergence between the long-term and short-term trend. That's why the monthly is strong buy, but the daily is strong sell. Because the long-term money is buying the bottom, but the short-term money is selling right now. Retail is stuck in the middle, buying in the middle, thinking it's the bottom, but it's not. The bottom is at 43.85. That's where the central banks are buying. That's where the big money is waiting. Retail is buying at 4,500, 44.80, right in the middle of the sell-off, getting trapped. That's the trap. Now, the 1 to 2 week directional lean? I'm bearish, short term. I think we are going to test that 43.85 level within the next 10 days. I think we are going to see that 5% pullback, that correction, before we bounce. What invalidates that? If we get a surprise escalation in the Middle East, if Iran attacks something, if we get new geopolitical risk, or if the Fed suddenly turns dovish, if one of the speakers says they're going to cut rates, or if we break that 4,550 resistance level on a daily close. If any of those happen, this bearish thesis is out the window. But right now, none of those are looking likely. Now, do you think gold breaks 43.85 this week? Comment yes or no. I'm tracking consensus. I want to see what you guys are thinking, because right now, the herd is overwhelmingly saying no. They think the support holds, they think the central banks are going to save them. But the data says something different. The data says that we are going to test that level, and we might even break it, before we bounce. Now, let's get to the trade setups. Most people skip this section. That's exactly where the money is made. Keep watching, because these are the exact setups I'm personally positioning for right now. These are the setups that the big institutions are using right now, and I'm giving them to you for free. First up, the sniper, the conservative play, for those of you who don't want to chase price, who want to wait for the highest probability entry. This is for the patient traders, the swing traders, the people who don't want to take a lot of risk, who want to wait for the perfect setup. This is my favorite setup right now, because it has the highest probability of working out. The setup here is simple. We are waiting for a pullback to that 4,508 level. That's the key support we broke yesterday, right? That level held as support for 3 days straight, and then we broke through it. Now, it's turned into resistance. That's the classic polarity principle, right? Support turns into resistance. Resistance turns into support. That's one of the most reliable patterns in trading. And that's where we are going to see the rejection. That's where all the retail traders who bought the dip are going to start selling, to break even. That's where all the new short sellers are going to enter. That level is going to hold, I promise you. The entry trigger? We need a 1-hour candle close below 45.08, confirming that the level is holding as resistance, that buyers couldn't push through it. That filters out the false breaks, it keeps you from entering too early, it keeps you from getting caught in a fake out. Because sometimes, price will spike up through the level, and then drop right back down. We wait for the close, to confirm that it's a real rejection. The stop loss? We are putting that at 4,520, just above the 5-day moving average at 45.13. Because if we break that level, that means the rejection failed, that buyers are actually in control, that they've pushed through the resistance, and this setup is void. We don't mess around. We get out immediately. The first target? 44.50, that's the first minor support level we have on the 4H chart. That's where we are going to see the first wave of buying interest. That's where the dip buyers are going to step in, so we take half our profit there. We lock in that gain, no matter what happens. The second target? 43.85, that 200-day moving average, the big support level we've been talking about this whole time. That's the full target, and that gives us a risk-reward ratio of 1 minute and 10.2 seconds. That means for every $1 you risk, you make $10.20 if it hits the full target. That's an insane risk-reward. That's the kind of setup that can make your whole month. Strategy 1. The sniper, conservative, entry, 4,508, 1H close below, rejection confirmation, stop loss, 45.20 take profit 1, 44.50 take profit 2, 43.85 risk, reward, 1:10.2 hour invalidation, void if daily close above 45.50. Next up, the active trader, the standard play, for those of you who want to trade the current trend right now, no waiting for a pullback. This is for the day traders and swing traders who want to take advantage of the momentum we have right now, who don't want to wait around for a pullback that might not come. This is for the people who want to get in now, while the trend is strong. The entry condition here. We enter short as soon as we break below 44.80, the current session low, on a 4H close. That confirms that the downtrend is still accelerating, that we are not going to bounce here, that we are breaking through the current support. That's the trend continuation setup, one of the most reliable setups there is. The stop loss? We place that right at 4,497, just above that key support level we broke yesterday. Because if we push back above that level, that means the break was false, that buyers are stepping back in, that the downtrend is over, at least for now. And we need to get out, no questions asked. The first target? Again, 44.50, that first minor support, we take half our profit there, same as before. Once we hit that first target, we move our stop loss down to break even, and we trail the stop by 20 points for the rest of the move. That way, we lock in our profits, no matter what happens. Even if price reverses, we don't lose money on the rest of the position. We let the rest of the position run to the next target, and we don't have to worry about giving back our gains. The second target? Again, 43.85, that 200-day MA, the big level. That gives us a risk-reward of 1 minute and 5.5 seconds on the full move, which is more than enough for a standard trade. That's a great risk-reward, way better than the 1:2 most traders aim for. Type your gold price range for tomorrow in the comments now. Let's see who's aligned. I want to see what you think price is going to do, if you're aligned with the institutional data or if you're part of the herd. Let's see who's right. Strategy 2. The active trader, standard, entry, 4,480, for H close below, trend continuation, stop loss, 44.97 take profit 1, 44.50 take profit 2, 43.85 risk, ear reward, 1:5.5 hour invalidation, void if price recaptures 4,508 intraday. Now, the third strategy, the aggressor. This is the high risk play, only for those of you who can lose small and manage risk aggressively. This is not for everyone. Don't try this if you're a new trader. Don't try this if you can't handle a loss, if you can't cut your losses quickly. This is for the experienced traders, the long-term bulls who believe that the monthly trend is still intact, that the central bank bid is going to hold that 4,385 level, that this is the bottom. This is the counter-trend play, betting that the sell-off is going to end at that 200-day MA, that we are going to bounce hard from there. The entry here. You enter long as soon as we hit 43.85, the 200-day moving average. No waiting, you buy the dip right there, betting that the support holds. That's the level where the central banks are buying. That's the level where the long-term money is waiting. That's where the bounce is going to happen, if it's going to happen. The stop loss? Tight, right at 43.70, just below the support level. Because if we break that, then the support is broken, the whole bullish thesis is out the window, and you get out immediately, no questions asked. You don't hold on, you don't hope, you just get out. Because if we break 43.85, then we are going to drop a lot further, and you don't want to be caught long. The targets? First target is 44.50, that first resistance level, that's where we take half profit, that's the first level we are going to bounce to. The second target is 4,508, the broken support, now resistance, that's the full target, that's where we are going to see the first big resistance after the bounce. That gives you a risk reward of 1 minute and 7.2 seconds, which is huge, but this is high risk. Because right now, the short-term momentum is all to the downside. There's a good chance we break that 4,385 level, and if you enter long there, you could get caught in a crash. That's why this is only for aggressive traders who can manage their risk, who can take that small loss if it doesn't work out. I don't recommend this for most of you, honestly. The first two setups are way safer, way higher probability. But if you're willing to take the risk, if you're a long-term bull, that's the setup. Strategy 3. The aggressor, high risk, entry, 4,385, immediate long on test of 200 MA, stop loss, 43.70 take profit 1, 44.50 take profit 2, 45.08 risk, air reward, 1:7.2 hour invalidation, void if 4,385 breaks on a daily close, never risk more than 1 to 2% per trade. No positions through high impact news. Stops are non-negotiable. This is how you survive to trade the next big move. Let's wrap this up. Let's make sure you have everything you need. The single most critical level for the next session? 45.08. If we see a pullback to that level, that's your trigger for the sniper short. If we break that level to the upside, the whole bearish thesis is gone. We are going to bounce, we are going to test 45.50, then 45.61. That's the level to watch. That's the make or break level for the next 24 hours. Tomorrow's focus? We've got another Fed speaker tomorrow. Waller, the same one who turned hawkish last week. He's speaking tomorrow afternoon, and that's the wild card. If he comes out even more hawkish, if he says they're going to hike rates in June, that's going to send yields even higher, and gold even lower. We could see another 1% drop in a single day. If he turns dovish, if he says that they're done hiking, that they're going to cut rates soon, that's going to trigger a massive bounce. We could see gold jump 2% in hours. That's the wild card we are watching. That's the thing that could change everything. Now, if you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Bitcoin is setting up the exact same trap. By the way, 72% of retail traders are long there too, and it's about to drop. That video is live now. Tap the end screen. Go watch it right after this, because that's where the next big move is happening. You don't want to miss that. Smash like if this gave you a clear plan, if you know exactly what you're doing now instead of guessing, if you're not going to be part of the herd that gets trapped this week. Smash that like button. It helps the video reach more traders. It helps them avoid this trap too. Subscribe, hit the bell, because tomorrow we are breaking down all 8 assets again, before the move, so you never get caught off guard. We do this every single day, institutional grade analysis, exact levels, exact setups, so you can trade with confidence. And I'll see you in the next one.